There is one ETF that made plus 845% over the last year, and another ETF which lost over 47% in value. So in just 1 year, some investors lost half of their hard-earned money, all while other investors got rich. You want to know the funny thing about this? This could have been prevented easily. At least a minus 47% situation. I'm working as a financial advisor for more than 7 years now. This doesn't allow me to predict future stock market returns, unfortunately, but it enables me to not lose 47% of my investment within 1 year because I follow clear criteria on how to separate a good ETF from a ETF. What are those criteria that allow me to find the best ETFs out there? Let me tell you in this PerFinEx investing video. First things first, before you even begin selecting your ETFs, there is one filter that is the most important of all. Pick an ETF that is domiciled here in the EU. Now, let me be clear. This does not mean that you should invest here in the EU only and not in the US or any other markets. This means that you should buy ETFs that are specifically designed for investors living here in the EU. You can easily identify them because they will have an ISIN, International Securities Identification Number, or the German version of it, a WKN, Wertpapierkennnummer. These ETFs you're allowed to buy, and these ETFs you should buy. That means you should avoid all these ETFs without an ISIN or WKN and just a ticker symbol, because ETFs with a ticker symbol are only for investors living in the US. Every once in a while, we get a message from one of you guys that reads mostly like this.
Ha ha, you're an idiot. I just opened an investment account and bought an ETF with a ticker symbol.
Congrats to you, my man. You just got yourself into probably the worst tax nightmare you can think of. If you circumvent the rules to open an account to invest in US ETFs, you're still subject to tax with your worldwide income here in Germany. So great job making your life a lot more complicated for no reason at all. And if you want to know how complicated, here's an interview I shot with Dirk, the tax advisor. So please buy an MSCI World or S&P 500 ETF or whatever the f you want to invest in that is domiciled here in the EU and not outside, for your own sake. Talking about things to avoid. As of making this video, there are more than 10,000 different ETFs out there, and every quarter there are currently 70 added to that number. That is 280 new ETFs every year. And with these more than 10,000 ETFs out there already, we can probably agree that you can invest in anything that you want already. A couple new ETFs may be good because the world keeps evolving, right? But a lot of these new ETFs are only hype. First it was the Bitcoin ETF, which is only available in the US, by the way, so you can't invest in them anyways. We talked about that a moment ago. Now it's an AI ETF, and we'll see what the next type will be after that. We'll talk about these new baby ETFs that are just being born later in the video. But for now, let's conclude that if the ETF is just based on hype and everyone throws money at whichever sector is currently cool, you probably want to stay away from it. The next selection criteria seems to be one of the biggest topics for you guys, even though it's not anymore. Some of you make this a way bigger deal than it needs to be. The almighty question if you should buy an accumulating ETF that reinvests the profits, or if you should buy a distributing ETF that pays out the profits to you. 2 years ago, my answer to this question would have been a lot different. But now we have the preliminary investment tax, Vorabpauschale in German, so it makes very little difference anymore. You can learn more about the preliminary investment tax in this video, so just in short here why you hate die Vorabpauschale, I hate die Vorabpauschale, everyone hates the Vorabpauschale. Finanzamt takes the value of your ETFs on January 1st, compares it with the value on December 31st of the same year, and if your ETF rose in value, you are taxed. Did you make a profit? Not if you ask me, because your ETF could fall in value tomorrow. You made a book profit. Okay, but according to my understanding, You only make a real profit once you sell an investment. And because of that ridiculous preliminary investment tax, it makes very little difference if you're taxed on your paid out profits or on your book profits. The only way to avoid paying for Abpauschale is to put your ETFs in pensions instead of investment accounts. That's what we discussed in this video, to find out that if you really invest over the long term, pensions can be a lot more tax efficient than the broker app on your smartphone. So if you wonder what the best way is to invest in ETFs for you, then you can book a free meeting with us right here. Now that we know that accumulating ETF or distributing ETF makes very little difference, we come close to answering the question which ETFs we should invest in by narrowing the filters. And one of the most important filter criteria for me, because we don't want to gamble the life savings of our clients away, is that we select well-diversified ETFs. Let's take our German DAX 40 as an example. It's not the DAX 30 anymore, as it was in the past. Now they added 10 companies to the index to make it DAX 40, which was a step in the right direction, but it's still if you ask me. The top 10 out of the 40 companies make up 61% of the total index, which is way too much in my opinion. With well-diversified ETFs, it's usually 20% only. And of course, you're invested in the German economy only. I'm German. I kind of like this country. We have our issues, but who doesn't, right? But would I invest here in Germany only? Hell no. So either you buy ETFs that are a lot more diversified than the DAX 40, for example, or you buy a portfolio with different ETFs and diversify that way. Your money, your choice. While we talk about the DAX, I want to warn you about another thing to avoid when selecting your ETFs. Here's the return of our DAX 40 over the last year. 14% plus. Pretty good, eh? So what if you would buy a leveraged ETF that leverages the performance times 3? 14% times 3 is 42%. Even better, right? The 3 times leveraged DAX ETF made only 30% and not 42%. Anyway, still better than the normal ETF, so you should buy leveraged ETFs, right? Well, let's look over the last 3 years. DAX made 15%, a tiny little bit better than over 1 year, so the 3 times leveraged ETF should have made 45%, right? 4% only. What the f is this? How is it possible that the 3 times leveraged ETF performs worse than the regular ETF if the performance of the underlying index is possible? The answer comes from the word daily. If the DAX makes plus 1% today, the leveraged ETF will make plus 3%. So far, so easy. But tonight, when the market closes, the leveraged ETF will be rebalanced to start tomorrow fresh, as if the previous day never existed. And since the DAX was in early 2022 and late 2023 all over the place, if you take a look at the charts, these leveraged ETFs do not produce the outcome that you think they do. So, stay away from them. If you want to leverage, use the only investment out there that is supposed to be leveraged, real estate, but stay away from leveraged ETFs. What you want to avoid as well, and we talked about that earlier, that there are hundreds of new ETFs launched every year, young ETFs with no track record. Don't get me wrong, I'm not saying that past performance is a predictor for future returns and you should buy whichever ETF was a great investment in the past. No, I would never say that. What I'm saying is that new ETFs have usually a low fund volume. Coincidentally, the next point on our list to avoid. Young ETFs with very little invested in them. 100 million is not that much to me, you know? Are kind of risky and could mean some extra work for you. Because if there's no demand from investors, the fund company will close the ETF again sooner than later. Your money will not be lost if the ETF is closed, don't worry. But it's also not fun if your ETF gets delisted. You have to wait a couple of days to receive your money, and then you have to find a new ETF all over again. And the last ETF criteria on our list is a personal tip from my side, because I've learned over the past 4 years of running this YouTube channel how most of you guys structure their personal finances. So you probably want to select an ETF that is eligible for a monthly savings rate, so you can dollar cost average. Dollar cost averaging means that you invest the same amount of money every single month, no matter where the market is currently. If you remember the DAX chart from just a moment ago, sometimes the market was down, this is when we buy relatively cheap, and sometimes the market is up, this is when we buy relatively expensive. But you don't try to time the market, which doesn't work anyway. Rather, dollar cost average, which is a lot better for your stress level anyway. Trust me on this one. What did we learn in this video? There are clear criteria what separates a good ETF from a bad ETF. We talked about them. If you follow all these criteria, will this mean that you will only make a profit from here on out and become a billionaire eventually? Probably not. Nobody can predict the future of the stock market. Not even me. But we can set the structure right and do the best we can to have the highest possibility of succeeding in the investing game. And if we can help you with that, then you can book a free meeting with us right here with the link that you see on screen.